What if your job didn't matter when applying for a loan? With a DSCR loan, it doesn't. If your rental income covers the mortgage, you could qualify. No W-2s, no tax returns, no income checks. These loans are built for investors, not employees. In this video, we'll break down how DSCR loans work, how they differ from traditional financing, who they benefit most, and the one number that can make or break your approval. Hit subscribe and take the first step towards smarter investing. Most people think banks care about your job, your tax returns, and how stable your income looks on paper. But with a DSCR loan, that doesn't matter. This type of financing flips the approval process. Instead of judging you, it judges the property. If the rent covers the loan payment and there's still some cushion, you might already qualify. No W-2s, no income checks. You don't even need to list your job, just the numbers. It doesn't matter if you're self-employed, between jobs, or just getting started. If the rent covers the debt, you're in the conversation. That is why it is called a debt service coverage ratio loan, or DSCR. And while the name sounds technical, the idea is simple. The rent pays the debt. That is what lenders care about. Let's say the property earns $4,000 a month and the mortgage is $3,000. That means the property more than covers the cost, and your DSCR is 1.33. Most lenders want to see at least 1.2 to feel confident in the deal. However, some lenders allow for a break-even ratio of 1. And in really rare cases, some lenders approve loans when the ratio is slightly less than 1. So even if you're building your portfolio full-time or don't have a conventional job, you can still qualify. If the numbers work, your deal speaks for itself. And once you understand that, the entire game changes. With traditional loans, lenders care about your job, income, and tax returns. DSCR loans don't. They focus on one thing: does the rent cover the mortgage? If it does, you can qualify, even if you're self-employed or between jobs. That's why they're known as no-income verification loans. You're not selling yourself to the bank, you're just proving the property's cash flows. Most lenders look for a DSCR of at least 1.2, meaning rental income should be 20% higher than your mortgage. You'll usually need 20 to 25% down, and interest rates might run slightly higher. But in return, the process is faster, simpler, and built around numbers, not paperwork. If the deal makes sense on paper, you move forward. No pay stubs, no stress. Once you own a rental property, a DSCR loan does not just help you buy, it can help you grow. Many investors use them to refinance properties they already own. Just like the initial application, lenders do not ask about your income, job history, or taxes. They care about one thing: is the property still performing? If your rental income is strong and your expenses are under control, refinancing can open new doors. You might qualify for a better rate or even a cash-out refinance, putting equity back in your pocket. In many cases, lenders will let you tap into up to 75% of the property's value. That cash can be used to upgrade the property, pay off higher interest debt, or fund your next investment. It's a smart way to scale without starting from scratch. When the property performs well, your options multiply. The process is simple but strategic. You will need to show 12 months of rental income, current mortgage information, and updated expenses. But timing matters. If cash flow dips or costs creep up, your DSCR could fall below the minimum and the refinance will not go through. This is why smart investors do not just refinance. They stay ready, because when the numbers align, this is not just about saving, it is how you scale. DSCR loans aren't for everyone, and that's what makes them so effective. They're built for borrowers who don't fit the traditional lending mold but still have deals that make financial sense. If you're qualifying based on a 9-to-5 income, a conventional loan might work better. But if you're focused on cash flow through rentals, DSCR loans could be a perfect fit. These loans are especially useful for real estate investment investors. That includes full-time landlords, Airbnb operators, and even first-time buyers with strong income potential. Many DSCR lenders don't cap how many properties you can own, and if the rent covers the mortgage, that's often enough. Some lenders even accept projected short-term rental income if you can back it up with at least 12 12 months of local data. They're also great for scaling. Traditional banks may stop lending after 4 or 5 properties. DSCR lenders often support portfolios well beyond that. You may need 6 to 12 months of reserves, especially for refinances. But if the numbers work, you stay in control. That flexibility is why experienced investors use DSCR loans to grow faster and smarter without being limited by what's on paper. Applying for a DSCR loan is surprisingly straightforward, especially compared to traditional mortgages. There is no need for W-2s, tax returns, or proof of personal income. What lenders care about is whether the property qualifies on its own. If the rent covers the mortgage and the numbers check out, you are already halfway there. The first step is gathering the right documents. That includes lease agreements or rental income history, bank statements, a breakdown of expenses, and your existing loan details if it is a refinance. Most lenders also want to see 12 months of rental performance and may ask for an appraisal to confirm the property's value. Your debt service coverage ratio is the number they will focus on most. Once your paperwork is in, underwriting is usually faster than a conventional loan. Many DSCR lenders can close in as little as 2 to 3 weeks, especially if the deal is clean and well prepared. But the real advantage here is control. You are not qualifying based on what you earn. You are qualifying based on how your investment performs. A lot of DSCR loan applications fail, not because the property's bad, but because the numbers aren't tight. The biggest red flag? Poor prep. Investors jump in with estimates instead of verified figures, or assume lenders will accept projected income without proper data. That rarely works. Here's the thing, lenders want proof. They want to see actual rent deposits, not just what you think the place could earn. If your numbers aren't solid, your deal can fall apart before underwriting even begins. Another pitfall is overlooking the finer details. Maybe the income looks good, but expenses were underestimated. Maybe the rent is seasonal, but the documents don't show that clearly. These small gaps add up and can throw off your eligibility. Successful applicants treat DSCR loans like a numbers-first playbook. They double-check everything, they plan ahead, and they show lenders a deal that's already performing, not one that just might perform. And that's it for this one. If you're thinking about using a DSCR loan, or you're already deep into your first deal, drop a comment and let me know where you're at. Are you just starting out? Refinancing? Scaling up? I want to hear it. If this helped you see the process more clearly, hit like, subscribe, and stick around. We've got more coming, and the next one might answer your next question.